In this video, we're going to look at two trading strategies using the idea of support and resistance. Hello and welcome back to our trading strategy series, Technical Analysis and Charting, with me, David Jones, and Trading 212. Now, last time round, I was talking about the importance of support and resistance, and we went through some of the basic principles behind it and how important I think it is and how plenty of new traders ignore it. So this time around, we're going to drill a little bit deeper. We're going to look at trading setups using this idea, where to place stop losses, where to get in, this sort of thing. Now, I think broadly speaking, there are at least two strategies we can use if we think a support or resistance level is going to hold. We can, first of all, wait for confirmation, or secondly, we can second guess the level's going to work. So without further ado, let's get into it. So first of all, let's look at the theory of waiting for confirmation. Then we'll look at two real examples in the markets. So let's say we're waiting for confirmation. We've got a chart here. The market's been falling. Maybe we think the market's going to turn around, and the level we're watching is the old low down here. So if we're looking for confirmation, it's not enough that the market just heads back to that level. We want to see, again, support coming into play. So if we have a market that's sliding, maybe we wait for, if we're looking at candlesticks, and this doesn't really matter whether we're looking at a daily chart, an hourly chart, 10-minute chart, we wait for at least one period where the market turns around. So maybe we have a positive candlestick, we have a sign of buying come in. That's our first bit of confirmation. And of course the reverse applies. If we're selling into resistance, we're looking for a day when the market does at least go down. Okay, there's our theory, all nice and simple, as theories tend to be. In the real world, it's maybe not quite as clear cut, but here are two examples from real markets over recent weeks. Here's a good example. This is the price of gold. We're looking at a daily chart here. So every day, every candle represents a day's worth of trading. Now, for much of 2017, we saw the price of gold in recovery. We did see sell-offs, but the market turned around and moved higher. So we're looking at this. This is up to the 25th of October. And we might think the same thing is happening again. We've had a run up, we've had a sell-off, the market's bounced back, we're coming back to the old support. What's going to happen? We might want to be a buyer, but we're going to wait for confirmation. Let's just pick up, first of all, on the support level we're watching. So we'll choose from up here on the platform, the horizontal line, and we'll put it under that support. So we can see the support is at 1260. So what we're waiting for is at the very least one day where the market goes up. We want to see it turn around. If it goes sailing through the support, there's no trade. The confirmation we're waiting for is one positive day. Let's walk forwards. So we have our day where the market has pushed lower, but you can see it's turned around on the day and has closed pretty much near the highs of the day. So for some people, that would be enough to confirm the support is valid. So we'd be a buyer around about, 1273, 1274. Obvious place for the stop loss, down below 1260, and we're in the trade. I've jumped forward to the present day. This was the turnaround. You can see it took a week of sitting on that support, but so far at least, the market has moved about $13 higher. So there's, I think, a good example of waiting for confirmation ahead of previous support would have set us up with a good trade. So now we're looking at a very different time frame. We're looking now at confirmation of a sell near resistance. We're looking at dollar yen. It's a 10-minute candlestick. Every candle represents 10 minutes worth of trading. This is the early hours of the 7th of November. The market rallies up from 113.70, rallies up 60-70 points up to 114.33. We see the market drop out the trend line. So this has made us think, okay, is this an opportunity to sell? If we go back up to here and fail, is this our opportunity to sell short? But again, we are looking for confirmation. So maybe we want to see, we're looking at a 10-minute candlestick. We want to see at least one 10-minute candlestick where the market runs out of steam. If it blasts through the level, there's no short. Let's just pick up on our resistance level up here. So the resistance level is there. I've walked forward just 10 minutes here to the next candle. You can see it right on the edge of the chart. So the market traded as high, 9:20 in the morning, UK time, traded as high as 114.33. We've seen this candlestick here trade up to 114.29, so within 4 points of the high. And it's turned round. So our trade here could be, we're going to be a seller at 114.18. with a stop somewhere above here, let's say 114.40, 114.50, something like that. But we're taking that as our confirmation of resistance. Short-term resistance, it was only formed about, 7 hours earlier, but that's our signal. Let's see what happened next. So over the course of the next 9 hours, it does actually end up being the turning point. There was no way of knowing when we put the trade on that the market was going to drop about 50 points. But it was a low-risk, logical place to go short because we had a definite reference point. If the trade doesn't work out, we get out for a small and manageable loss. So arguably that's the more disciplined way of doing it. Wait for the market to confirm this is a valid level. But if we want to be more aggressive, we can anticipate that a level is going to hold. So again, let's take a quick look at how it should work in the theoretical world. When it comes to anticipating support resistance holding, it's a much more aggressive trade. We're hoping that we get in at maybe a better price. So rather than waiting for the market to turn around, we're buying or selling when the levels approach. So for example, going back to this chart here, we just be a buyer in here with our stop loss below. So we are, in effect, we're second guessing the market is going to turn around, but accepting the risk, of course, it could just sail straight through. So we're giving up the extra confirmation, but we're hoping to get in as near as possible to that big level. Now clearly there are going to be more examples of anticipating because it's going to work, I think, a lot less often than looking for confirmation. So as usual, we'll look at two examples, one that does work and one that doesn't work. So here's our more aggressive strategy. This is euro dollar, zero spread, 4-hour candlestick. Every candle represents 4 hours worth of trading. This is the middle of October. So the market, euro dollar, has traded as high as 118.80 and has sold off pretty hard, sold off down to 117.30. So we've seen a 150-point decline. The market is bouncing back, but we think that that level is going to hold. We think that the old resistance up here, let's just pick it up with our line, it's going to be a barrier. So the level is 118.80. Let's say our stop loss is 118.95, something like that. The market's trading up here. You can see during this 4-hour period, the market traded as high as 118.57, 118.60. So we may decide to be a seller at 118.40, where this market has traded. So we're waiting for it to just push a little bit higher. Then we're going to sell because we're going to assume that old resistance is going to hold. It is a more aggressive strategy because we're second guessing the resistance. Let's see what happened over the next 4 hours. So the market has pushed higher. Let's say we got filled at 118.40, but it's carried on higher still. So at the moment, the trade is underwater. We're down 15, 20 points, but we're still guessing that that old resistance is going to hold. It was a big level, and we did see it tested on the way down, but that's what we're assuming here. We then get, over the next 4 hours, a fairly indecisive candle. If we were waiting for confirmation, this could well be the confirmation for some, but we're taking a more aggressive stance here. We're already in the trade. Let's see what happened next. As it turned out, the market did turn down. If we'd have waited for a more negative candle for confirmation, we wouldn't have been getting in until back down here. So anticipating it, higher risk, but arguably gives us a better fill. But the risk is the market would have just gone sailing through that old level. Let's look at another example. So now we've got a much more short-term example. It's a 10-minute chart of the German 30. Like many stock markets, it has had a very strong year, being dragged higher by US stock markets. What we're looking at here, each candlestick represents 10 minutes worth of trading. It's the 7th of November. We've seen the market hold at 13,340. And you can see it has quite a few goes. 8th of November, we're back, and again a bit later, and again the 9th of November, we're back, and the level just about holds. It does push through. So we see the market pushing down. You can see it just here, getting back to that level. So again, our aggressive strategy would be to be a buyer now, assuming this level is going to hold. What happens next? And the DAX, the German 30 index, just sailed through the level like a knife through butter. So if we had been waiting for a confirmation there, we'd never have done the trades, but we run the risk of the market turning around sharply. But this shows why it's even more important, if you're taking an aggressive approach and anticipating levels hold, that you have stop losses in place. Because here's a clear example where the market didn't care that was previous support and went sailing through. So you can see one of the drawbacks there of trying to anticipate is that you end up just jumping out in something in front of what is a runaway train. The upside is you'll get better entries. The downside is, as we saw with that DAX example, bang, it just goes sailing through the level. I think maybe if you're new to trading, then maybe the logical, the safer way to do it, first of all, is to wait for the confirmation. It builds up the discipline, it builds up the patience, and I think these are both incredibly important factors when it comes to trading. We're going to explore this in a bit more depth again next time round. We're going to look at trading breakouts. Clearly, these levels don't stay in place forever, because if they did, markets would never go anywhere. So we do see support and resistance levels break. So we'll cover that next time round. As usual, if you've got any questions or comments, or you disagree with what I've said, just put us a message down below in the comments. We do read them all. If you like the video, click on the thumbs up, and to make sure you never miss out on the range of videos we produce during the week, if you click that button there, you'll get subscribed, and there's like an alarm bell thing down there. If you click on that, you'll get notified every time a new video is uploaded. But for this week, for this section of our charting and technical analysis course, we'll leave it there. So I hope you have a good trading week.